When you earn interest on a bond or a dividend from a stock, you're going to have to pay some taxes. Now, in most cases, the interest on a bond is taxable. There are a few exceptions. If the bond comes from a particular state or municipality, it might be tax-free. For all other bonds, however, the interest that you earn gets added to your gross income from your wages and salaries, just like the interest from your savings account did.
If the stock you own pays a dividend, you owe taxes on the dividend amount. Dividends are taxed at the rate corresponding to the income tax bracket you are in. This is not added to your gross income like interest is. If you are in the 33% tax bracket, then 33% of the dividend amount is what you owe in taxes. This is in addition to the taxes you owe on your regular and interest income.
There's another tax issue for stocks and bonds. If you sell a stock or bond for more than you pay for it, then you've made a capital gain. For example, if you buy some stocks for $50 and later sell them for $75, you've made a $25 capital gain. You may have to pay taxes on that $25, depending on what tax bracket you're in and how long you've owned the stock. If you own the stock for less than 1 year, you've made a short-term capital gain, and the $25 is taxed at the rate corresponding to the income tax bracket you're in. This works just like the tax on dividends. If you owned the stock for more than 1 year, you've made a long-term capital gain. Here, you might not owe any taxes. If you're in one of the lowest two tax brackets, you pay 0% of the capital gain in taxes. If you're in the very highest tax bracket, you pay 20% of the capital gain in taxes. And if you're in one of the other brackets, you pay 15% of the capital gain in taxes. These tax rates do not change on a yearly basis. Congress needs to pass new legislation in order to change them.